And ladies and gentlemen, we are live. The Dylan Holy Experience is live, 7 p.m. Pacific Standard Time on the West Coast, 10 p.m. Eastern Standard Time for my people holding down the East Coast. Shout out, love y'all, love y'all, love y'all. The Dylan Holy Experience is live with its midweek market recap. And I will say it, the markets aren't really, in terms of price action, showing how fun it's been this week, but there is some pretty killer news. We've had a pretty killer news cycle. And on top of that, I think it's stuff that's just interesting. Like, I think there's just interesting stuff coming out. Stuff's bubbling up. And let's just jump right into it. Stock futures tick higher after Wednesday's rally. Stock futures ticked higher in overnight trading Wednesday. Futures tied to the Dow Jones Industrial Average added 12 points or 0.03%, while those tied to the S&P 500 and NASDAQ 100 gained 0.25% and 0.27%, respectively. Salesforce's stock shed 6% and extended trading on news that co-CEO Bret Taylor is stepping down. Snowflake shares, can they even say that? Can they say Snowflake anymore? I don't know if that's allowed. I feel like that's hate speech. I think CNBC might be perpetrating hate speech, dude. For real. But no, Snowflake shares tumbled about 5% on light product revenue guidance. The overnight moves followed a sharp rally during the regular trading session, with the NASDAQ Composite and the S&P 500 snapping three-day losing streaks as Federal Reserve Chair Jerome Powell appeared to confirm a slowdown in the central bank's tightening, a question that has lingered in recent weeks. And you bet your sweet bucket, we're going to be talking about the meeting notes and minutes from Jerome Powell's speech today to, I believe, the Brookings Institute. I guess we can spoil this a little bit, but yes, the Brookings Institute. That's what's up. That's what's up. Shout out Brookings Institute, the current employer actually of a former Federal Reserve Chairman Ben Bernanke. Who would have thought? Interesting stuff. Anyway, I don't really want to spoil this. So we're gonna jump into that later. On Wednesday, the Dow jumped 737.24 points, or 2.18%, to 34,589.77, while the tech-heavy Nasdaq and S&P 500 surged 4.41 and 3.09% respectively. All 11 S&P 500 sectors finished the day higher, led by technology stocks that have come under pressure this year on fears of slowing growth. All the major averages finished November higher. The Nasdaq rose 4.37%, its second positive month in a row for the first time ever since a 3-month streak ending in December of 2021. Both the S&P 500 and Dow rose 5.38% and 5.67% respectively to finish their second month of gains for the first time since August of 2021. Whew. Well, I can't deny it. It was a relatively good day on the markets today. We can actually, let's just go ahead and pull up TradingView. Let's just take a look at this actual price action. I'm definitely not saying a bottom is in. I'm not here to say we have reached a bottom. I truly, and I think I can speak for all members of the millions and pretty much all investors. No one really knows when the bottom's going to happen. No one really knows at all. Like, we are all equally clueless ultimately when it comes to this market. That being said, there has been a rebound, at least in the short term. I have Bitcoin up right now, but the Dow Jones Industrial Average definitely has rebounded. It's undeniable that they have rebounded. The S&P 500 does the same thing. They have rebounded. And actually most blue chip assets have, or large cap assets. People usually attribute blue chip to that, but it's across most industries we've seen rebounds. So with Bitcoin obviously still down horrendous this year, I believe at this point 76-77% down from an all-time high. We can take up handy dandy CoinGecko for that one. Let's take a little gander here and see the historic price. Okay, yeah, so Bitcoin is still down 75%. Bitcoin is still down 75% this year, but it has found a rebound in recent weeks, at least from a macro standpoint. So I guess we'll have to see there. That being said, so I actually saw this stat on Twitter a few weeks ago, and when I say that I invest, I try to approach it with like a macro context, and I really think that's important, especially in my case, I dollar cost average, and I think most people who are successful long term in the stock market, they do dollar cost average as opposed to that lump sum type of investment where time in the market beats timing the market. Are we going to get some numbers here? Come on, man. No question. Are they really going to deny the millions a Twitter feed? Come on, man. Okay. Well, basically, what the Twitter feed was saying, that this price action on Bitcoin, obviously Bitcoin has underperformed the S&P 500 this year. That is absolutely no question. Bitcoin has underperformed the S&P 500. Now, if you look at the previous price action to Bitcoin and you compare Bitcoin to itself in previous cycles, so if you compare the Bitcoin price action from, say, 2017 to 2018 or 2013 to 2014, what you see, historically speaking, is every time Bitcoin has a major downturn, a major downturn, it has been going down, at least from a percentage standpoint, less and less and less. Obviously, in terms of a monetary standpoint, Bitcoin is down, $52,000 from last year. So from a purely dollar standpoint, yes, Bitcoin has lost more money this decline as opposed to previous corrections. But if you look at the Bitcoin percentage, this is actually the least volatile downward action we have seen Bitcoin in from a percentage point to like a macro correction ever. So again, full disclosure, I am dollar cost averaging into Bitcoin. Full disclosure, I am dollar cost averaging into the S&P 500. I'm not saying that, this is a good buy for Bitcoin. At this price, this is a good buy for Bitcoin. For me, I buy things that are a good buy for me. And dollar cost averaging into Bitcoin and the S&P 500, I think for myself is always going to be a good buy. I will say, I definitely like buying Bitcoin at $17,000 more than buying Bitcoin at $69,000. But that's just my personal risk tolerance. I like buying these. I like buying Bitcoin. I think Bitcoin's solid. Now to run it back to again the macro market, undeniably a rebound. And what's interesting is this rebound is happening. It's going down. We over a significant amount of weeks. It seems like the actual labor markets, and I think personally overall this is a good thing, but it seems like a lot of the actual indicators of what the economy goes by, so like job growth and inflation, those have actually been cooling down. And I think what's actually driving this upward price action is partly market relief from seeing, okay, inflation is definitely cooling down now. That's okay. That's a good thing. I've even seen arguments that seeing labor growth cool down is also a good thing. And funnily enough, we are seeing just that. Private hiring increased by just 127,000 jobs in November, well below the estimate, ADP reports. So this is not the U.S. Labor Bureau. This is not their stat. That'll be coming out at the end of this week, and you bet your sweet bucket we're going to be covering that on the end of the week market recap. So if you haven't already, go ahead and follow twitch.tv/RealDMH. Be sure to follow me there. Then I want you to go to Twitter. Follow me at Real Dylan Holy so you can see when I go live with your midweek and end of the week market recap for that matter. And of course, just some other fun, some fun little content that I put up. I have key takeaways on there. I give my thoughts on the market, and it's broad market stuff. So we talk about the indexes, but we also talk about some interesting stories and bits of news that you may not have seen. So at Real Dylan Holy on Twitter, and of course on YouTube, youtube.com/@DylanHoly. So now you just can't miss when I go live, and then we have fun. We have a fun little discussion. But let's continue on with this ADP report. Private companies added just 127,000 positions for the month, a steep reduction from the 239,000 in October, and well below the 190,000 person estimate for this month. Leisure and hospitality saw an increase of 224,000 jobs, but that was offset by losses in manufacturing, professional and business services, financial activities, and information services. Very, very interesting stuff. And it may not be surprising, but we are still seeing, job growth, but this is being offset by like a significant amount of contraction for tech companies. And we're going to be talking about a tech company just after this that's actually going through that exact thing. But, you've seen Meta layoffs, the Twitter layoffs, the 5,500 Twitter employees laid off. They got severance packages. And here's the other thing too. Yes, it sucks that people got laid off. I'm not here to say like laying off people is good. That's a good thing. No. Anyone who's lost their job, I'm sorry. I'm sorry that you lost your job, and I hope you get back on your feet. I have nothing but the best of wishes for you professionally. And also, most of these tech companies, they pay out really good severance. Like they have those people in terms of their money, they just got a massive cash infusion. Obviously, they have to live off of that until they find a new position, but they're being well taken care of. But let's continue on with this ADP jobs report. Private hiring slowed sharply during November and a sign that the historically tight labor market could be losing some steam. According to a report Wednesday from payroll processing firm ADP. Companies added just 127,000 positions for the month, a steep reduction from the 239,000 the firm reported for October, and well below the Dow Jones estimate for 190,000. It was also the lowest total since January of 2021. The relatively weak total comes amid Federal Reserve efforts to loosen up a jobs picture in which there are still nearly 2 open positions for every available worker. So the amount of jobs being offered to people are 2 to 1. So if you are a single person, if everyone in America if every person that is unemployed in America were to get a job, only 50% of those jobs that are open right now would be filled. So there still is a labor shortage and a worker surplus. But I think that the physics are starting to catch up on rate hikes. It was an insano world. It still is an insano world in terms of the housing market and the real estate market. The prices are still kind of out of whack there, at least historically speaking, compared to when there is quantitative tightening. But the labor market is starting to slow down. I think this is exactly what they wanted to start doing. And, it sucks that we underperform on jobs, but also this is exactly what they were wanting to happen. The central bank has raised its benchmark borrowing rate 6 times this year, but the unemployment rate is still 3.7%, near the lowest since 1969. So like I said, still a relatively hotter labor market. But again, I still think stuff is going to contract. Quote, turning points can be hard to capture in the labor market, but our data suggests that Federal Reserve tightening is having an impact on job creation and pay gains, said ADP's chief economist, Neela Richardson. Quote, in addition, companies are no longer in hyper replacement mode. Fewer people are quitting and the post-pandemic recovery is stabilizing. So I think this might be the end for the Great Resignation, dude. I think Great Resignation jobs are I think that phase of job migration and labor migration, I think it's coming to an end. The ADP report comes 2 days before the Labor Department releases its closely watched non-farm payrolls count, because of course they can't talk about having farm payrolls, because if so, it would be like we would have pretty close to negative job growth. Like, dude, the farm payroll count, they don't talk about it. That is terrifying. Hold on. We gotta pull this up. Okay, no, this is showing non-farm. Give me the farm payroll. There we go. Give me farm labor. Give me some numbers. Give me some charts, man. All they're showing is non-farm. Dude, where is it? Where are you? No, I think, okay. They don't even want to show it. We're gonna find this, and I'm gonna show it to you all one day, because like I'm telling you, and you bet your sweet bucket, we're gonna be speaking ad nauseum about this farm payroll count once we actually get a chart that is reputable. All they're showing is non-farm payrolls right now, and let me explain to you why. Because there is a declining farming industry in America. Actually, you know what? It's not going to be the actual farm payroll count, but I will at least be able to show you the certain percentage of people that are based in agricultural work, and this is coming directly from legendary economist Martin Armstrong from Armstrong Economics. And let's take a look here. So I was reading this article today. It's about the Dutch farming crisis, and we can actually talk about this for a bit too, because this is also a very interesting story. So, yada, yada, yada. Okay, this is one of those unbelievable stories of how climate change is being taken to such an extreme, we will unleash a serious wave of deaths from both starvation and coming freezing temperatures without fuel. The Dutch government is actually planning to buy out and close as many as 3,000 farms in the country, which set off a major protest with growers, and it stood against their insane leaders' attempts to now cut the country's nitrogen emissions by 50% according to the EU deadline of 2030. So we spoke about this a few weeks earlier, but the EU, they came out and they basically passed a bill saying that they will cut down on CO2 emissions, and then and it was part of an overall greenhouse gas type of, we're going to cut our greenhouse gas emissions down. One of those being nitrogen. And who would have thought having cows, they tend to poop a little bit, and then some nitrogen comes out, and then there's nitrogen in the air. So let's see what's going to continue on in this article here. We'll now cut the nitrogen emissions by 50% according to the EU deadline of 2030. Let's scroll down a little bit. There we go. These Dutch politicians have now said that they plan to allocate some $25 billion to buy out farmers, stripping them of their farms and livelihood. They want to now purchase between 2,000 and 3,000 Dutch farms, stripping them of their property rights and the very freedom that is the distinction between a free society and an authoritarian dream of relentless and endless power. Where the Great Depression was made really great because there was also an environmental crisis known as the Dust Bowl. This time, politicians want to create that same crisis all over again. Agriculture accounted for 40% of the civil workforce at the time in the United States during the Dust Bowl, the Great Depression. This is what drove unemployment to 25%. It was farmers losing their livelihoods because of the Dust Bowl. This time we have politicians deliberately seeking to create a major food crisis, all in the name of climate change. All right. So there's that little spiel. In terms of my thoughts on it, I definitely think maybe you shouldn't, as a country, destroy your food sovereignty. Like they're literally just actively being like, yeah, in the next 8 years, we're just going to destroy our food sovereignty and then just rely on corporations that just process their food. So, don't know if they should have done it, but this is what we're really looking at. This is what we're really after. All right. And now, this isn't even factoring in today. This isn't even talking about 2022. This is from 1900 to 1980, and this is the U.S. civil workforce. So this is basically just, and obviously the source is Armstrong Economics. Feel free to fact check Martin Armstrong all you want. I'm sure he would love to hear your opinion on this. But let's look at the U.S. civil workforce from 1900 to 1980. So in 1900, 41% of the entire working population was in the agricultural industry. 41%. By 1980, so 80 years later, agriculture only made up 3%. And that was from 1900 to 1980. That's not even factoring in the 42 years we've had since between 1980 and right now. And this is an even lower number. But just for the sake of this argument, let's use the 3% number. All right? They are not talking about the 3% number in this. All right? They're not talking about the massive loss in farm labor and agriculture and agricultural labor in the United States. So that's why I think non-farm payroll numbers are bullshit. That's same thing with my core CPI numbers. All right. How are you just not going to include food, or even with the consumer price index? How are you just not going to weight food to be as important, as the price of a used car? Food is the most important thing. When there is inflation, that's what people talk about the most. They don't give a shit about a used car price. They do not care at all. It's food, dude. It's food. And they refuse to talk about food, or at least weight it in the CPI. So yeah, they're playing around with some numbers. This non-farm payroll stuff. All right, give them what you want. If it inflates your numbers and you want to blast that one out, you go for it. But there is a serious farm labor and agricultural labor crisis in the United States. And obviously, that is not the only thing that's driving down this month's numbers. We've also seen some massive losses, like CNBC has mentioned, in the manufacturing, professional and business services, financial activities, and information services. Now, on the topic of information services companies and information technology companies laying off some of their workforce, Meta's been guilty of this year. Twitter, they also laid people off. I think most of it was just kind of trimming the fat off. Same thing with Meta. And now there is another one that has come out today, and that's DoorDash, which has announced plans to lay off 1,250 employees. CEO Tony Zhu told employees that 1,250 corporate workers would be let go as part of a broader cost-cutting initiative. In a message released to the public, Zhu offered 17 weeks severance and 2023 vesting as part of the severance package. So, like I said before, they are still being given a pretty good severance package. Just over 4 months of pay. And then I think they're going to talk further about it later. Maybe not. Nah, they're not. So, yeah, 17-week severance. Again, the tech companies pay out. So, yes, sucks the workers lost their job. Anyone who was offset by this laying off, this layoff, I'm sorry that you have to go through it. Best of luck to you, professionally and financially. But y'all are talented. Y'all fucking got this in the bag. It's all good. Y'all are going to get a job, and then you're just going to be chilling. It's just going to be a better job than DoorDash. It's all good. Now, I do want to talk about the financials of DoorDash for a little bit, because I was interested in seeing, or just running rough numbers of how much money they would actually be saving from laying these employees off. So DoorDash employee median wage or median salary. I think they're all salaried with those fancy schmancy corporate jobs. So let's do that, and then we're going to go to DoorDash's Yahoo Finance. And here is why I'm bringing this up. So if we take a look at their actual balance sheet here, let's go to their financials. If we take a look at their balance sheet here, the most important number from their cash flow statement, excuse me. So their free cash flow is their most important number. Basically, how much money after expenses and everything are coming through the company, and expenses are like the operating expenses, and then on top of that, taxes and credits and stuff like that. So it's 191,000 and thousands of dollars. So let's go ahead and pull up. Is this the annual? This is the annual. Oh, and it's the trailing. Sweet, dude. They're already setting us up for success. All right. So 191,000. All right. So they're cash flowing, free cash flow, trailing 12-month, and this is just straight numbers. Of course, not financial advice. I'm just taking a look at it, and I'm looking at numbers, and we're gonna add some numbers together, and then say this is what they would theoretically be making. So right now they're free cash flowing $191 million. All right. So let's keep that number in the wings here. We have it right here. It's just saving it for us, dude. Shout out to Random Access Memory, and they're just making the impossible possible. Now, the average DoorDash employee makes $99,000 a year. That's the average base salary, right? Average base salary. So it's $99,000 per year. And if we run back to the actual DoorDash numbers, did I drop those out? All right. Well, I think I closed out of that tab. So $99,000 per employee, and they laid off 1,250 employees. They would be saving in expenses of paying out employee salaries $123,750,000. So they are saving. Let me actually run the numbers on this. So 123,750,000 divided by 191 million. They would be making, at least theoretically, and these are very, very rough numbers. Obviously, everyone's salary ranges and everything. This is just that mean average salary. They could increase their operating cash flow by 64%. or free cash flow by 64%. That's staggering. So again, there is a lot of bloat that tech companies, information tech companies have, and DoorDash is one of many information technology companies where they're just bloated, they're overvalued. Netflix was probably one of the worst offenders. Meta as well, where they were their earnings reports, they were not making a bunch of money, and the market just valued them so high because they're an information technology company and they just IPO'd and everyone knows their name. DoorDash is worth $22 billion. So I just don't know, man. I mean, their earnings per share are negative $1.53. So they are still hemorrhaging money. So hopefully this could act as a way for them to stop hemorrhaging money. But I'm not investing into these companies right now. I'm not investing into these companies right now. So let's continue on. Now, one of the chief driving factors that has completely changed this market dynamic from where we were basically last year to now has unequivocally been the Federal Reserve, and the Fed Chair Powell says smaller interest rate hikes could start in November. Federal Reserve Chairman Jerome Powell confirmed Wednesday that smaller interest rate increases are likely ahead and could start as early as December. So, this is something we've been saying on the midweek and end of the week market recaps for a while, and on the Dylan Holy Experience for a while. They're probably going to drop it down to 50 after this. We were saying, and Jerome Powell actually spoke about this in the October meeting, and he said that they are guaranteed to bump interest or basis points, and this was 2 months ago. 2 months ago. Wow, man. Time be flying. But yeah, 2 months ago. And they said that they were going to bump it by 125 basis points. So at least a 75 basis point jump and bump in November, which we got. And then at least a 50 basis point bump in December, which he is now saying could start in December. And he's just holding true on what they were saying before. I think now they can get rid of the super aggressive monetary policy, because that is what they've done with the monetary policy and rate excuse me, and rate hikes has been unprecedented. Like, there's never been any other price action like this before, and monetary policy action like this before. He will say, and does say, quote, "We will stay the course until the job is done," that being Jerome Powell. Federal Reserve Chairman Jerome Powell confirmed Wednesday that smaller interest rate increases are likely ahead, even as he sees progress in the fight against inflation as largely inadequate. Echoing recent statements from other central bank officials in comments at the November Fed meeting, Powell said he sees the central bank in position to reduce the size of rate hikes as soon as next month. But he cautioned the monetary policy is likely to stay restrictive for some time until real signs of progress emerge on inflation. Quote, "Despite some promising developments, we have a long way to go in restoring price stability," Powell said in remarks delivered at the Brookings Institute. The chairman noted that policy moves such as rate hike or interest rate increases and the reduction of the Fed's bond holdings generally take time to make their way through the system. Quote, "Thus, it makes sense to moderate the pace of our rate increases as we approach the level of restraint that will be sufficient to bring inflation down, aka the physics are now starting to catch up. That time, or the time for moderating the pace of rate increases, may come as soon as the December meeting." Wall Street applauded the remarks. Dow Jones closed 737 points higher, and tech stocks fared even better, with NASDAQ Composite and the S&P 500 also breaking a 3-session losing streak. So, yeah, they're slowing down interest rate increases. At some point it was going to come, At some point it was going to come. And it's good that they're at least maybe starting to look at tapering it out, slowing it down a little bit, because now stuff is starting to fall in line more and more and more and more and more. And I think this is just the start of dominoes starting to fall over, and whether the actual price action ends up going up or down on those events and physics catching up, you never really know. But I just to give you some reassurance, even if stuff does start to slow down, which I don't know it will, but even if it does start to slow down, I'm still dollar cost averaging. I can't advise anyone else to, nor will I. But I will tell you that I am still buying the S&P 500. I am still buying Bitcoin. I am still buying Ethereum. I am still buying Solana. Not a bunch of it. I was never buying a bunch of it, but I'm still buying Solana. I think that I like the tech. I like the tech. So, of course, not financial advice, just me telling you what I do. And regardless of where the S&P 500 goes, whether it be up or down or sideways even, I'm just going to let the robots auto invest for me. I have the automatic investing stuff on. I'm just going to continue to buy. Now, speaking of purchasing these assets, speaking of having actually robots doing the auto investing for you, one of the biggest brokerages and investing financial institutions on planet Earth, Fidelity, has opened up retail crypto trading accounts. So on Fidelity this week, I've signed up on the wait list. I think I'm going to be taken off in about a month or so. They've told me via email. But on Fidelity, you can now purchase spot native Bitcoin in your Fidelity accounts, man. This changes everything in terms of mass market exposure and retail exposure to crypto, because now the single or in the top 3 financial institutions in America in terms of investments and the ability to invest, the others being Vanguard and Charles Schwab, Fidelity is now letting users purchase spot native Bitcoin in their Fidelity accounts. And what makes this so significant, Dylan? Well, now they're testing the waters to see, well, do people want to do this? Do people want to invest into this asset class? This is the Bitcoin. If we're looking at cryptocurrencies, Bitcoin is still the big daddy. He's the granddaddy, dude. He runs the game. Still, people can talk shit on Bitcoin. Oh, it doesn't have any use case. Regardless of that, regardless of what you think, it's undeniable that Bitcoin is the biggest cryptocurrency on planet Earth. And if you're wanting to actually test out consumer demand, Bitcoin is going to be that first experiment. Now, the fact that Fidelity is doing this, they are one of the largest providers of 401ks, Roth 401ks, IRAs, and Roth IRAs, one of the largest providers of those services. Now, I'm not saying that Fidelity is going to cram down people's throats, buy Bitcoin, buy Bitcoin, buy Bitcoin. And I am not saying, oh, you should buy Bitcoin in your Roth IRA and in your 401ks. I'm not saying that at all. What I am saying is they're now testing the waters, probably for the functionality and capability for people to be able to invest into Bitcoin and in their 401ks and IRAs and Roth 401ks and Roth IRAs. And I think that there is going to be more people investing into Bitcoin once they add capabilities into their retirement accounts. That's what I'll say about that. But I do think this is pretty seismic news. Now, on the topic of financial institutions, especially involving cryptocurrencies, there's probably no bigger meltdown of a financial institution crypto-wise than FTX. And Sam Bankman-Fried has given an interview and sat down with yeah, sat down with the New York Times in that same type of conference deal that Zelensky was at, and that I believe Nancy Pelosi was at. Or no, excuse me, it was Mark Zuckerberg. Mark Zuckerberg was there. So it was Mark Zuckerberg, SBF, Zelensky, and I believe one other guest speaker. But SBF sat down with someone for the first time since basically I think this FTX fiasco happened. And let's see what was said. Striking a contrite tone, former FTX CEO Sam Bankman-Fried said, quote, "He didn't do a good job at upholding his responsibilities to regulators, customers, and investors in a hotly anticipated conversation with CNBC's Andrew Ross Sorkin at the DealBook Summit." Sam Bankman-Fried's FTX imploded in mid-November after CoinDesk reported irregularities in the company's balance sheets. The company filed for Chapter 11 bankruptcy protection in Delaware on November 11th. Quote, "I didn't ever try to commit fraud on anyone," Bankman-Fried said. "I saw it as a thriving business, and I was shocked by what happened this month." Quote, "I've had a bad month," Bankman-Fried added later. "We completely failed on risk," Bankman-Fried continued. "That feels pretty embarrassing in retrospect." Sam Bankman-Fried appeared by video feed from the Bahamas, Sorkin said. "I've been in the Bahamas for the last year," Bankman-Fried said when asked about why he remained in the island nation. Sorkin also asked Bankman-Fried what motivated his acquisitions in the crypto industry, given the size of Alameda's borrowing from companies Bankman-Fried intended to acquire. Bankman-Fried claimed that he believed that by the middle of 2022, Alameda would have repaid all lines of credit to various borrowing desks, but Alameda still owes BlockFi over $670 million, according to court filings. Quote, "What are your lawyers telling you right now? Are they suggesting it's a good idea for you to be speaking?" Sorkin asked the former billionaire, to which Sam Bankman-Fried responded, "No, they are very much not thinking it's a great idea." Quote, "The time that I knew there really was a problem was November 6th, Bankman-Fried said, after Alameda's sizable FTT position was exposed by CoinDesk. When we looked at that, there was a potential serious problem. Alameda had taken a huge hit by that point. We were seeing a run on the bank start," Bankman-Fried said. "I was nervous when the Alameda balance sheet was exposed by CoinDesk, but expected the damage was going to be limited to Alameda and not an existential crisis for FTX." Now, Bankman did go on to say the U.S. platform is fully solvent and funded. Bankman-Fried claimed, "I believe withdrawals could be opened up today and be made whole." So people may be able to start pulling their money off of FTX US. I haven't attempted to do it. I didn't have any funds on there. So I have no zone of reference. But hopefully someone who does have their funds on FTX US, well, hopefully you didn't have your funds on FTX US because that would have been messed up. But if you do and we're able to pull it off, please pass it on. Yeah, I would love to hear what's going on with people, especially because I want to be able to see if this is actually happening in context. They also asked SBF about his drug use. "Can I ask you about the drugs?" Sorkin said. And Bankman responded, "It's funny hearing this. I have half a glass of alcohol a year." Man, I don't know about SBF, man. I cannot believe. Dude, the chief liquidator for FTX, John J. Ray III, who did the chief liquidation for Enron, said that FTX is the biggest meltdown he's ever seen. Like, he's never seen a company that was more chaotic and strewn about than FTX. So I don't know. SBF, man, I really cannot. I think at this point, billions of dollars were lost because of the reckless financial nature of FTX and just generally crypto companies as a whole, because it's an unregulated industry. I've always been about regulation. I've always been about regulation and consumer protections for the cryptocurrency industry. And SBF did not adhere to those guidelines. SBF sat in front of Congress and told people that he adhered to those guidelines and perjured himself in front of Congress. That happened. So I don't know. He can say, SBF can say what he wants. Oh, I didn't know. I just didn't know. All right, man. But I don't believe it. I don't believe it. Now, speaking of crypto institutions that are, not really doing fantastic right now, BlockFi has filed for Chapter 11 bankruptcy as the FTX fallout spreads. FTX also loaned them $675 million, and I don't know if BlockFi can pay that. I think based off of this bankruptcy proceeding, I don't think BlockFi can pay that. Now, speaking of financial institutions, everyone they look at the FTX issue and that meltdown, and they were saying, see, yeah, like if you do a bank run, you can just tell if the institutions are good or not, because the institution would melt down if there's a bank run. And obviously, this is to no defense of FTX. I do not believe FTX was well managed from a capital standpoint and a solvency standpoint. But there is a lot of blind eye being given to the traditional financial institutions as well. And according to one analyst, and obviously this is an op-ed from him, so take it with a grain of salt. But according to him, banks are short more than $1 trillion in capital. And he fears the shortfall will only get worse. The new year is nearly upon us, and one idea for where to invest is the banking sector, whose margins benefit highly from the high interest rates at not terribly demanding valuations. Here to counter that view is Christopher Wallen, the chairman of Wallen Global Advisors, who makes the bold case that banks were short over $1 trillion in capital at the end of the second quarter, and it's only going to get worse as the Fed keeps hiking interest rates. That claim may surprise those who think the U.S. banking industry has some $2.2 trillion in capital, but he whittles that figure in several ways. First, he notes there's a difference between book equity and tangible equity, the latter of which, that being tangible equity, is used by the banking regulators to evaluate solvency. It's a narrower definition, excluding items like goodwill and tax-deferred assets. That brings the total down to $1.49 trillion from the $2.2 trillion. So $1.4 trillion in the tangible equity, actual United States dollars. Then drawing on the Federal Deposit Insurance Corporation data, so the actual, basically the FDIC insurance, where banks have to be transparent, at least to some degree, about their holdings and their cash reserves in consumer deposits. He subtracts what's called the accumulated other comprehensive income. Thanks to quantitative easing and now tightening, all sorts of assets have become negative return propositions for banks and non-banks alike. If the coupon pays less than the funding costs, you're losing money. That takes the capital down to $1.23 trillion. Now comes the more controversial part. First, he marks to market losses on loans and securities created during 2020 and 2021 for the impact of this year's Fed rate hikes. That rate there is enough to push banks into solvency, with some $1.74 trillion of losses from marking to market. And another $794 billion in losses comes if bank holdings of U.S. Treasury securities, mortgage-backed securities, and state and municipal securities are also marked to market. Put it all together, on Whelan's calculations, and banks have a $1.3 trillion shortfall as of the second quarter. All right, let's talk about this number here. $1.3 trillion in terms of capital shortfall. Again, this is an op-ed piece. Take it from face value and take it with a grain of salt, of course. Or do not take it at face value and take it with a grain of salt, please. Please. But this is what a fiat system does. And on top of a fiat system, this is what a fractional reserve lending system does to a market. let's talk about fractional reserve lending for a little bit. Basically, this idea, and we've covered this on the Dylan Holy Experience before, no question. But it is worth talking about. Basically, fractional reserve lending, we are the depositors. We are the people giving the banks money, right? So we are transferring money to the bank. Now, with fractional reserve lending, what the bank can do, and what they actually have to do now because of the Basel Accords that came after the financial crisis of 2008, the Great Recession, they have to leave most of the money in demand deposit reserves. So basically, checking and savings accounts, they have to leave most of that money in there. So if people need it, they can access it. If you will, consumer deposits. Now, most of that money's there, barring, of course, a bank run. Now, the rest of that money is then used as collateral, giving it out to loans, market making, doing money markets, cash flowing, doing on unsecured cash flow managers, stuff like that. So what this banking model does, and obviously that banking model has propelled our economy, at least from a monetary level, to great heights. But this type of banking model also awards an extremely dangerous mindset, which is basically using the money, levering the money, and then getting to a point where you have a bunch of liabilities in different types of derivatives and investment assets. This being inherently risk on by actively investing the money into different types of things. It's dangerous for the actual consumer, because what happens if they lose that money? What happens if something actually goes crazy? The bank actually defaults on their loans. Then that causes a bank run. And these people, they are insured up to $250,000 per depositor, of course, for different types of accounts and products. But there's not enough money to cover that. And then there's a bank run. That's what happened to FTX. That is exactly what happened to FTX. They took most of the money, and they said that they held it in reserves. They didn't touch user funds. And then they invested the rest out. They gave it to Alameda Research. FTX did. They lent it out to different crypto lenders. But then they actually just took the user funds and the actual cash reserves that they said they had, and then they loaned those out too. So that was an even bigger problem. And then of course that shit spiraled. But if you guys think that this is crazy, I posted this on Twitter, and it's definitely worth talking about here. But banks, let's bring it down. Let's bring it down a little bit. There we go. The banks, even just talking about total assets. So this isn't including homes and stuff like that. But if you're just talking about the straight cash number, it's even less. Banks have overall, banks have $2 quadrillion in overall derivatives. $2 quadrillion by basically the 25 largest banks in America. That's a lot of leverage and a lot of debt for the amount of consumer funds they have, especially being based off of a fractional reserve lending model. So I'm not going to say that there's going to be a bank run on the big banks and all the financial institutions in America. I'm not going to say that. I don't know if that will or will not ever happen. I don't know what's going to happen to these financial institutions. What I will say is they have a lot of stuff that they at some point are going to have to pay up on. And at least according to Mr. Wallen, I don't think he thinks they're going to be able to pay up. and he's worried about their solvency. Now, I want to take a turn to retirement accounts after this. Hardship withdrawals from 401ks reach a concerning all-time high, Vanguard says. So what is a hardship withdrawal? Basically, if you need the money from your 401k, then you're able to sometimes take money out from it. You'll have to pay a 10% fee on it, or a 10% penalty on it, or you can even take hardship loans from it, where you basically use your investment assets as collateral, and then you can take a loan out and get the money now. Hardship withdrawals have reached an all-time high in 2022, and this is going back to 2004. Of course, it was 0.5%, so it's not a majority. It's a very small minority group of people, but it is definitely interesting seeing that hardship withdrawals have hit an all-time high. There's more people pulling from their 401ks than ever before. That's really sad. I don't like seeing that. There's just no other way to put it. I think it's difficult for people. And even last year, 1.9% of Fidelity's 401k participants took a hardship withdrawal. From January to October 2022, the share of people taking hardship withdrawals was 2.2%. Anyway, that's all I'm going to speak about this. It's just rough. It's rough seeing people take the loans out on their assets that they own. It's unfortunate stuff. Now, lastly, and I blasted this on my key takeaways and on my Twitter, and I don't know why anyone talked about this. The global population hit 8 billion people. That's crazy. 8 billion people, man. There are 8 billion people on planet Earth, and I don't think there's any signs of stopping soon. Stuff's not slowing down, and at least in the currently industrializing countries. In the post-industrial countries, I'm talking U.S., Western Europe, most of the developed countries, if you will, they are slowing down in terms of their populations, now to the point of possible population collapse. But overall, for the planet, we have hit 8 billion people. In a statement, the UN figure meant 1 billion people had been added to the global population in just 12 years. Unprecedented growth is due to the gradual increase in human lifespan, owing to improvements in public health, nutrition, personal hygiene, and medicine. It is also the result of high and persistent levels of fertility in some countries, the UN statement read. So, welcome, 8 billionth person. It's absolutely wild stuff, man. And that's where I'm going to leave that midweek market recap. Thank you very much for watching, spending 54 minutes with me on the Dylan Hoy Experience, giving you that midweek market recap. If you liked what you saw, be sure to follow on Twitch or subscribe on YouTube, depending on which one you're primarily watching on. And then I want you to go vice versa. So twitch.tv/RealDMH, youtube.com/@DylanHoly. And if you want to see what I'm doing on Twitter, I'm doing key takeaways on there. I'm giving people, again, important information, fun and interesting financial news stories that I see all the time, all day long. And of course, you will be the first to know when I go live with the Dylan Hoy Experience. Always on Twitter @RealDylanHoly. Thank you very much for watching, and you have a fantastic rest of your evening.